The single most repeated piece of retirement advice in Western financial media is a variation of the same sentence. Delay filing for Social Security as long as possible, ideally until age 70. And for a specific slice of retirees, that advice is exactly correct. But Social Security Administration data shows something almost nobody discusses. In the United States, more than 60% of workers file for Social Security before their full retirement age. Roughly a third file at 62, the earliest possible age. Roughly another 25% file at 63 or 64. Only about 10% of eligible workers actually wait until 70. If early filing were as universally suboptimal as the standard advice implies, we would be looking at the largest sustained financial mistake in American economic history. How is it that a mistake this expensive gets made by more than half the eligible workforce, generation after generation, without financial media noticing? The answer, in most cases, is that the standard advice doesn't apply to the situations early filers are actually in, and they know it, even if they can't articulate the math. What we're actually looking at is something more interesting. A widespread, ground truth revealed preference that in specific situations the standard advice does not address, early filing is the mathematically correct move. Over the next 20 minutes, we're going through 5 of those specific situations. Not to argue that everyone should file early, to argue that wait until 70 is not a universal rule, and to walk through the specific cases where filing at 63 quietly beats the standard advice on every measure that actually matters. Before we get to the 5 cases, one number matters. The Social Security Administration builds its benefit adjustments around a specific mathematical assumption called actuarial neutrality. In principle, if you live to your statistical life expectancy, the total dollars you receive over your lifetime is roughly the same whether you file at 62, 67, or 70. The larger monthly checks from delayed filing are meant to compensate exactly for the fewer years of payments. Actuarial neutrality is real, and it is the reason the wait longer advice is defensible for the average person. The break-even age, the age at which delaying to 70 starts to outperform filing at 63, sits between 79 and 82 for most people, depending on the discount rate you apply. Live past that age, waiting wins. Here's what the standard advice quietly assumes. It assumes you will live to your statistical life expectancy. It assumes you have no dependent spouse who cannot claim their own benefit until you file. It assumes you have 0 portfolio assets that could benefit from an extra 7 years of compounding. It assumes you can and will continue earning income between 62 and 70. It assumes you have full control over when you actually retire. Change any one of those assumptions, and for millions of American retirees, at least one of them is not true. And the math flips. What does the math flips actually mean in practice? Running the same calculation with your own specific inputs, your life expectancy, your portfolio, your spouse's situation, your control over when you can stop working, often produces 63 as the correct output instead of 70. That output is a rational response to your specific case, arrived at through the same actuarial logic that produced the general rule for the median. What follows is the 5 specific situations where the math flips, in rough order of how often they show up in the real filing data. Case 1. You have a spouse who does not have a substantial earnings history of their own, and their retirement income depends significantly on Social Security spousal benefits. This is the case that catches the largest number of couples off guard because the rules are not intuitive. Social Security allows a spouse with a lower earnings history to claim benefits based on the higher earning spouse's record, up to 50% of that spouse's primary insurance amount at full retirement age. But there is a critical rule embedded in the mechanics. The dependent spouse cannot claim spousal benefits until the higher earning spouse has actually filed for their own. If the higher earner waits until 70, the dependent spouse waits until 70 as well. Let's do the math with concrete numbers. Assume the higher earner would receive $2,800 a month at full retirement age of 67, and approximately $3,900 a month if they wait until 70. The dependent spouse's spousal benefit would be roughly $1,400 a month at full retirement age. If the higher earner files at 63, both begin collecting. Over the 7 years from 63 to 70, the spouse alone receives roughly $1,400 a month times 84 months. That is $117,600 of household income that would not exist if the higher earner delayed. Yes, the higher earner's monthly amount is smaller, around $2,200 instead of $3,900. But the household total across those 7 years is substantially higher, and the dependent spouse has income of their own during a period when many households need liquidity for real reasons. For couples where one spouse has spent significant years out of the paid workforce, raising children, caring for a parent, working for a family business without formal earnings records, this case applies almost universally. Boston College's Center for Retirement Research has published extensively on how spousal claiming interacts with early filing. Their consistent finding? For households in this category, filing the higher earner's benefit at 62 or 63 unlocks household income earlier and, in a majority of model scenarios, produces higher total lifetime household benefits than delayed filing does. The wait until 70 rule, applied to a single earner couple, quietly costs the household somewhere between $80,000 and $130,000 over the 7-year window before the max benefit filing age. Who does this rule apply to? If you or your spouse spent 5 or more years out of the paid workforce and did not build a substantial retirement account of your own during those years, you are almost certainly in this case. The numbers above are a floor, not a ceiling. Real households often see the delta at $160,000 to $200,000 over the delay window. Case 2. You have credible reasons to believe your personal life expectancy is shorter than the population average. This case is the most emotionally loaded of the 5, but the math is the clearest. The Social Security break-even age sits between 79 and 82 for a healthy average person. If your reasonable estimate of your own life expectancy is below that number, because of chronic health conditions, family genetic patterns, career-related physical impact, or documented lifestyle factors, delaying benefits becomes a bet against your own likely outcome. Specific triggers to consider. Family history. If both parents and multiple grandparents died before 80 from causes with strong genetic components, your baseline expectation shifts. Chronic conditions. Diabetes, cardiovascular disease, and several forms of cancer meaningfully reduce statistical life expectancy from what the standard SSA tables assume. Career physical toll. Workers in construction, mining, agriculture, and heavy manufacturing have measurably shorter post-retirement lifespans than office workers on average, roughly 3 to 7 years shorter depending on the industry cohort. Environmental exposures. Certain industries and geographies carry documented long-term health impacts. Any of these can shift your personal break-even age below the population average by several years, sometimes by a decade. There is a second layer here worth naming. If you are married and your spouse depends on survivor benefits, the amount the surviving spouse continues to receive after the higher earner's death, the calculation becomes more complex, and delayed filing can still make sense for the survivor's benefit, even if it is suboptimal for your own. But if the surviving spouse has robust benefits of their own, or if the household is single income and the survivor's benefit at your earlier filing amount is sufficient, the case for early filing strengthens. This is the case where the general advice about leaving money on the table completely misses the point. You cannot spend money that arrives after you are gone. From what I have watched over the years, this is the case most people either handle correctly by instinct or fail to handle by trusting general advice that assumes their personal situation looks like the median. Which side you land on depends almost entirely on whether you ran the personal math or accepted the general answer. What did your parents die of, and at what ages? What did their parents die of? What health conditions are you carrying right now that shift your baseline expectation? These are uncomfortable questions, and most people never sit down and answer them explicitly. From what I have watched, that avoided audit is the single most common reason early filing gets rejected when it should have been the correct call. Case 3. You have a substantial investment portfolio, and you're worried about the first 10 years of retirement, when a market downturn combined with mandatory withdrawals can permanently damage the portfolio's ability to recover. This is called sequence of returns risk, and it is the single most quantified retirement threat in the last 30 years of financial research. William Bengen's 1994 SafeMax paper, The Origin of the Well-Known 4% Rule, was fundamentally an analysis of this risk. Michael Kitces has spent his career refining it. The core finding: 2 retirees with identical portfolios, identical withdrawal rates, and identical 30-year total returns can end up with radically different final balances depending on when the market goes down within that 30-year window. If the market drops 30% in year 2 of retirement while you're withdrawing 5% for spending, the portfolio has to overcome both the drawdown and the withdrawals. Often, it cannot. 15 years later, you can be in a materially worse position than someone who had the same portfolio but happened to retire during a bull market. This asymmetric outcome is why sequence of returns risk is treated as the single largest post-retirement financial threat by researchers who focus on the withdrawal phase. Now consider what Social Security income does to this equation. Every dollar you receive from Social Security is a dollar you do not need to withdraw from the portfolio. If you file at 63 and receive $2,200 a month instead of waiting until 70 for $3,900, that is $26,400 a year of portfolio withdrawal you avoid during the exact window where sequence of returns risk is most damaging. Over 7 years, 63 to 70, that is roughly $185,000 of portfolio preservation during the years when preservation matters most. Even at conservative return assumptions, the compound benefit to your portfolio balance at age 70 from having not withdrawn that money is often larger than the additional lifetime benefits you would have received from delaying. For portfolio-heavy retirees, early Social Security functions as portfolio protection more than as income supplementation. The mechanism prevents the specific damage that mandatory portfolio withdrawals in a bad market would create. Damage that, once it happens in the first decade, is rarely recoverable in the second and third decades of retirement. I have watched retirees with almost identical starting portfolios end up hundreds of thousands of dollars apart at age 85, purely because of the year in which they retired and the market conditions of the first 5 years afterward. What is the safest thing a portfolio can do during a bear market in year 2 of retirement? Nothing. Do not touch it. The closest a retiree can get to that ideal is reducing withdrawals, and Social Security income at 63 is exactly the tool that makes reduced withdrawals possible. Case 4. You cannot reliably work between 62 and 70 because of layoffs, ageism, health, or physical exhaustion. And delayed filing would require drawing down other assets to bridge the gap. This case is more common than the standard advice acknowledges. Age discrimination in professional hiring starts around 55 and becomes severe past 60. Physical work becomes progressively impossible for most people between 55 and 65. Post-pandemic labor market patterns show workers over 60 pushed out of workforces at rates well above previous decades. If you are 62, out of work, and looking at 7 years before your intended Social Security filing date, you have 2 options. Option 1. Draw from savings and investments to cover living expenses for 7 years. Depending on your spending level, that is anywhere from $200,000 to $500,000 of portfolio consumption before Social Security even starts. Option 2. File Social Security at 62 or 63, live on that plus a smaller portfolio withdrawal, and let the remaining portfolio compound. In this scenario, the delayed filing produces more lifetime benefits argument stops being relevant, because the alternative involves rapidly depleting savings that were meant to fund the rest of your life. The math for this case is simple to run for your own situation. Estimate your expected annual living expenses. Multiply by 7 years, the gap between 63 and 70. Compare that number to the difference between filing early and filing at 70 in terms of lifetime benefits, discounted appropriately. In most cases, when involuntary retirement is real and other portfolio assets are the alternative bridge, filing early wins on both liquidity and total wealth preservation, even if it produces smaller monthly checks in the very long run. What are your options at 62 if the layoff is not theoretical but real, and the job market has been quietly closing doors on you since 58? Nobody plans for this contingency until they are in it, and by then, the choice window is narrow. The households that hold up best in this scenario are the ones that ran the math ahead of time and knew exactly what filing at 62 or 63 would produce. So when the situation arrived, the decision was already made, and only the timing needed to be executed. Quick pause. The next case is the one that catches out even careful planners. The case where filing early seems to leave money on the table, until you look at the numbers from an angle almost nobody runs. If this breakdown has been useful, hit subscribe. This channel walks through actual retirement math instead of general rules, and holds that line video after video. Case 5. You have a substantial portfolio, you don't strictly need Social Security income for spending, and you want to use those checks to accelerate wealth preservation rather than fund consumption. This is the counterintuitive case. It applies to people who theoretically don't need Social Security at all, and it is where the highest earning retirees quietly file early and reinvest. The mechanics. You file at 63. You receive roughly $2,200 a month, or $26,400 a year, guaranteed by the U.S. government, inflation-adjusted, and delivered on the first of every month, regardless of what markets do. If your household spending needs are already covered by portfolio income and pensions, That $26,000 a year is a bonus. You can invest it into taxable accounts. You can fund Roth conversions and reduce future required minimum distributions. You can delay withdrawals from tax-advantaged accounts, letting them grow for 7 more years. You can gift it to grandchildren while alive, reducing future estate exposure. Each move has real dollar consequences at high net worth. The strategic argument is subtle. A dollar of Social Security received today is a certain dollar. A dollar promised 7 years from now is probabilistic, subject to policy changes, means testing proposals, and program adjustments Congress has been debating for a decade. Michael Kitces has written extensively about this from a portfolio strategy angle. His conclusion, worth quoting in spirit: for high net worth retirees, taking Social Security early and reinvesting can produce equal or superior outcomes to delayed filing when you account for the risk-adjusted comparison, the tax planning optionality, and the value of certainty today over probability tomorrow. You are trading a slightly smaller monthly check for immediate certainty, additional years of investment optionality, and full control over how the money is deployed. For a household that doesn't need the income to live on, that trade often wins on total wealth by the time everyone reaches age 85. Why would someone who doesn't need the money file early? Because the option to reinvest $26,000 a year for 7 years, with compound growth working over the same window, is often worth more than the increase in monthly benefit that delaying would produce. From what I have seen from the highest net worth retirees who file early, this is the calculation they run silently, and it is one of the reasons the "file early is always a mistake" rule sounds so obviously wrong to anyone in this cohort who has actually done the arithmetic. 5 cases, 1 point. The single most common piece of retirement advice, wait until 70, is defensible for the median retiree with no dependent spouse, average health, average portfolio, and complete control over when they retire. It is quietly wrong for roughly half of American retirees, whose actual situations include at least one of the 5 cases we just walked through. Spouse who depends on spousal benefits. Life expectancy considerations that shift the personal break-even below the population average. Portfolio sequence of returns risk during the vulnerable window. Involuntary early retirement without a viable 7-year bridge. High net worth reinvestment optionality. None of this is an argument that everyone should file early. It is the argument that wait until 70 is a rule calibrated for the median, and most people are not the median. What is required is the personal math, your own life expectancy estimate, your own spouse's benefit situation, your own portfolio, your own labor market realities. Those numbers change the answer for a lot of people. And the standard advice, held as a universal rule, quietly costs the households where it does not apply. If any of the 5 cases described your situation or the situation of someone in your household, the correct next step is to run the numbers for your specific case, ideally with a fiduciary advisor who has no product to sell you. The default answer for many people when they finally run those numbers is not 70. It is 63. And that answer, held for the right reasons, stands as a considered financial decision, arrived at by running the personal math instead of accepting the general rule, which is exactly the kind of decision retirement planning is supposed to produce, and almost never does when the general rule is treated as the answer. Which of the 5 cases describes your situation, or someone in your household? The point of the exercise is not to convert everyone to early filing. The point is to take the general answer off the table so the personal math can produce the correct one, whichever number that turns out to be. It might be 70. It might be 67. For a lot of people, in a lot of specific situations, it will be 63. Which answer belongs to your case is a question worth 30 minutes with a calculator and an honest look at your own numbers.